Good afternoon, everybody. It is David Perlmutter from Quantum Listing, and welcome to our Wednesday webinar. We are joined today by Kent Fitzpatrick of Asset Strategy Advisors and Bill Lopriore of First American Exchange Company, LLC. And we're going to have an engaging and informative conversation that will answer all your questions on opportunity zones, 1031s, and Delaware statutory trusts and more. We are excited to have another webinar with Kent and his team at Asset Strategy Advisors, and we're thrilled to welcome Bill to our webinar for the very first time. If you are joining, if you've already joined and you haven't yet muted your microphone, please do so now. Before we launch into today's presentation, I want to thank our wonderful sponsors, the News Funnel. The News Funnel, especially now that we're all working from home, is more important than ever as a great resource to bring us commercial real estate news. You can go to their website, you can sign up for their daily emails, you can put their feed on your own website. So thank you, folks at the News Funnel. And Kent, take it away.
All right. Thank you, David. I'm going to just switch to sharing my screen just so I can advance the slides without making you crazy here. Let me know if you can see that first slide there.
Yep.
Great. Okay.
Can you maximize the window?
I would love to. There we go. I think that's it.
All right, great.
Thank you, David. So again, my name is Kent Fitzpatrick, and I'm here today with Bill Lopriore, who is an attorney and also a qualified intermediary, or we used abbreviation, which I'm sorry, our industry uses a lot of abbreviations, as a QI. So Bill, when I turn it over to you, I'm going to ask you to explain what the heck a QI is, because we forgot to include that in the deck. And then I probably want to have you start by just commenting on how this coronavirus pandemic is really affecting the whole 1031 business before we get into the weeds. But our agenda today will be, we'll give you all some basics on 1031, an overview of Delaware Statutory Trust, which is a kind of a special segment of 1031. Qualified opportunity funds, we'll get into that a little bit more. I'll give you a brief overview and just some things to think about. And then just a few closing comments about COVID-19, and we're going to open it up to question and answers shortly. So with that, our firm Asset Strategy, we are a registered investment advisor and securities brokers. We've been in the business for over 30 years. We focus on tax solutions and retirement consulting and wealth management. Bill, maybe I'll let you tell the story of your organization.
Sure. First American Exchange Company is the subsidiary of First American Title Insurance Company, and we're one of the largest title insurance companies in the country and part of the public company known as First American Financial Corporation. The exchange company does strictly exchange work and underneath the title umbrella.
Thank you. There's a smiling shots of both Bill and I with a little background, which I won't dwell on that, but Bill, I'm going to just start by asking that question again. Can you just explain to our audience what is a QI, and then if you could maybe add some comments about 1031 before we get into the details on how it's being affected with the coronavirus now?
Sure. So a qualified intermediary is basically, it's a defined term in 1031. Essentially, the 1031 regulations require that you put your assets out of your reach into an independent party, somebody who's not your agent, and they just define that party as a qualified intermediary. So, in a sense, you could think of us. That is our company. Our company provides exchange services, and we are a qualified intermediary when we do so. Since we haven't represented our clients in any other capacity, we're not disqualified, and so we're a non-disqualified agent. Now, it's very important to note that the fact that we're owned by a title insurance company, and we're not the only QI that is owned by a title insurance company, does not disqualify us. They can provide title services, that's an exception, we provide these exchange services, and it's simply an independent party. But we use that term, qualified intermediary, not to be confused with qualified intermediary in the international banking context, different use of the same term in the tax code. Now, the coronavirus, how is the, interestingly, we've been very, very busy the last few years. 1031 has been taking off, and doing so right up until, I would say, last week. I mean, I'm still getting new calls, but they have declined. And it isn't that there isn't money out there in the marketplace for people to sell and buy. People are just concerned because everyone needs to be socially distant, to be stay apart, stay in, and they can't look at properties. So I'm confident, at least in my belief, I can't predict, that there is money out there to spend, and when this thing is over, it would ramp up again. But it's been very busy right up until last week.
Bill, any indication from the powers that be that they might extend deadlines for 1031s?
No, sadly. So, and we'll talk about disaster extensions when we get later into the definitions, but the question that Dave is asking is, given that people can't move about and purchase property, there's some very tight time frames that we'll talk about to complete a 1031. And in certain disaster situations, the IRS has extended those. They have not done so for coronavirus. Now, our trade association and along with about 30 or many other national real estate associations have written a letter to Treasury Secretary Mnuchin requesting extensions, but there's been no response. So right now, you must live with the 45 and 180 days, which we will explain momentarily. We're hoping it will come down, so, but we don't know.
Great. Thank you, Bill. All right, then let's jump right into it with your first slide here.
Okay, so really, what is a 1031 exchange? It's very, very simple, actually. If you've owned an asset, let's say you bought an asset for $500,000 many years ago, and now you're selling it for $2 million. Essentially, that gain would be taxed as a capital gain if you simply sold it and took the money. You also probably have depreciation on that asset, which you'd pay some gain taxes on. What 1031 allows you to do is defer paying your capital gains tax. And when we talk about capital gains tax, we're including both gain and growth as well as depreciation recapture. You are deferring paying tax on that because you are exchanging that property, essentially selling it and reinvesting into another property of like kind that is held for investment or used in business. Now, a couple of key terms here, okay? Defer, that doesn't mean it's tax-free. The only way that becomes tax-free is when you pass away, there might be some stepped up taxes, but you're deferring the tax to a later day. But you can do it over and over again over the years. And exchange simply is a term of art, which means you're selling something and buying something that's like kind, and you're doing it within the time frame of the 1031 rules and complying with the rules. It's really a sale and a purchase, but we can't call it that for tax. Now, the other thing is the held for. It's very important that you hold it for a certain period of time. When we say held for investment or business, we mean not personal use, and we mean holding for at least a couple of years with intent. Now, what are the taxes we're talking about? We're talking about certainly federal capital gains tax on the growth, 15 or 20%, depending on your income that year. Remember that if you don't do a 1031, the gain on that asset is counted in with your regular income, so it might put you over the top in some of these limits. You might end up in the 20% range. States tax capital gains just like the federal government does, and their rates can go from 0 to 13.3%. There is a Medicare tax. These all get deferred if you do a 1031. The Medicare tax is basically a tax on investment income, not just real estate investment, any investment income, stocks, bonds, whatever. And if you make us over a certain amount, single income over 200,000, married over 250, when you sell your real estate at a gain, you'll pay an additional 3.8% tax on it unless you do a 1031. Depreciation recapture is at 25%. In my example of 500,000, you might have depreciated that down to 100. Well, you'll pay 25% until you reach back at that 500 stage. You'll basically pay back the depreciation you took over those years and then start paying tax on your gains at 20%. So those are the taxes you can defer in a properly structured 1031. Now, what do we say? It must be an exchange. This is important. There's a whole structure, myth around what an exchange is. Do you intend to do an exchange? Are you selling property to buy property? And are you following the rules, keeping the money outside of your reach and following all the rules using a qualified intermediary? You can't just give the property and the money to your friend or your lawyer. You have to work with an independent party. So if you do those, if you follow the rules, the IRS will take your sale on day one and purchase as much as 180 days later. Call it an exchange. It's a tax term. Like-kind property held for investment, okay? After December 31st, 2017, 1031 is only for real property, okay? So pretty much like-kind is very easy. Any US real property is like-kind to any other US real property. I did mention held for investment. So you do have to be holding this for investment or business use. You could use it in your own business. If you have a real estate office and you own that, you could sell that as and replace it with other real estate, either for rental or to use your office again. It is not for personal use or primary home use or anything like that. Now, 45 days to identify, 180 days to close. These are the time limits. We'll talk a little bit more about those on another slide, but be aware that when you look on the internet, you might see 60 days or 90 days. You see all kinds of things that I've heard. This rule has been there for years and years and years. It's never changed. 45 days to identify what you might buy and 180 days to complete the closing, okay? If you want to pay no tax, you buy replacement property of equal or greater value and equity. So if you sold for my $2 million example and you want to pay no tax, you'll buy for $2 million. If you had a $600,000 mortgage on it and you had equity of $1.4 million, you want to buy with all of that $1.4 million equity and not have more than $600,000 mortgage, unless you buy for a higher value. So we'll talk a little bit more about that on another slide as well. Equal or greater in value and equity to defer all your tax. It's okay to buy lower. Same taxpayer rule. Now this is kind of interesting. When you, again, if you do research on the net and you look at some of these rules, you may often see the title holder who sells must be the title holder who buys. It's not really title holder, although 90% of the time that will be the same. It's the taxpayer. If Bill Lopriore sells real property, then either Bill Lopriore needs to buy. That's the same taxpayer and title holder. But I can also buy in a single member LLC because that LLC is not a tax entity if I'm just the sole member. So that's the same taxpayer. So title's not always indicative. Ask your qualified intermediary. Couple of key benefits. There's several key benefits. Yes. Good. Okay. Several key benefits to doing an exchange. Look, this is all about increasing your cash flow. All right. If you don't have to pay tax on your capital gains, you've got more money to spend on the new property. The example here is trading vacant land for improved property that might give you some rental, but it can also be done with any property, a property that's lower in value and a place that's deteriorated into a better location. Appreciation, and that's exactly this example, lower rent market areas to acquire in a different location. Conversion, now this one's a bit tricky, okay? So acquiring property suitable for future conversion, that can be okay, but the held for rules do incorporate a concept of intent. So what this is about is somebody might want to buy a property, sell a rental, maybe a two-family or multi-family rental, and buy a property someplace where they might want to retire. And it might be a vacation property that they want to move into later or something. You know, you can convert properties later, but your intention when you buy it really needs to be investment. You really can't have an overall plan to convert it, okay? You have to be careful about that. It's a holding period of a couple of years plus intent to be an investor. Now, after you've rented for a few years, people do convert to personal use if they want to now live in a place. That's something that came on later, okay? So we'll talk about vacation homes a bit later as well. There's some tricks to that. But the bottom line is buy with the intent to hold for a couple of years. Later on, if a new plan comes into being, so be it. Now, problems with joint ownership, very complicated. If you own property in certain entities like an LLC with multi-members, a partnership, and you sell property, remember I told you the tax owner of the sale has to be the same as the tax owner of the purchase. So the partnership sold, the partnership must buy. But you know what? I haven't met a partnership yet where everybody gets along. In fact, they usually hate each other after 20 years. So they want to split up. and some want to cash out, and some want to reinvest in an exchange. How do you do that? You get a tax advisor who can help you structure a breakup of that partnership into some fractional ownership, like a tenancy in common. And if you do it properly, you can minimize some risk that the IRS would challenge it. They might challenge it, but you could minimize it with the right advisor. And some of you go forward exchanging your fractional interest, and some of you take your cash and pay your tax. Very complicated. The QI can't advise you on this. They can just get you to a tax advisor. You want to reduce management burdens, okay? You don't want to manage anymore. You've managed until now you're retiring, and you don't want to be fixing the plumbing and calling the carpenters and the home improvers. You want to buy something you don't have to manage. Now Kent is going to talk a lot about DSTs and the benefits of those, and that can be something that you can exchange into without having the management burdens. Tax write-off, well, restored depreciation. As I told you before, if you can buy for more money, if you sell a $2 million asset and buy for $5 million, you've exchanged the $2 million, so the basis there rolls into that $2 million, but you've got $3 million of new value that you can start depreciating. So you can do that in a 1031, increase the value of your assets with new money. Estate planning, this is perfect, very common tool here. I told you this is a deferral. You're only deferring taxes until some future date. However, in the estate planning world, we all know that if an individual dies, then their heirs take a stepped up basis. Essentially, if I have a property that I bought for $500,000 and when I pass away, it's worth $2 million, the date of death value is what my heirs take it at. The gains that occurred while I was alive are gone. My heirs take it at $2 million value, no gains. They could sell it the next day for no gains tax. So you can wipe out taxes by dying. It's an unfortunate way to go, but it works. Otherwise, you're deferring taxes until that day. So the great estate plan is continue to do like-kind exchanges until you pass away and your heirs get this benefit of the stepped-up basis. Relocation, the most common reason to do a 1031. You just want to not be invested here anymore. You want to be invested over there, moving to new locations. And we can change the slide. So I've talked about like kind. Like kind used to have a lot more meaning when it wasn't just real estate, but for real estate, like kind has always been very broad. All right. Any U.S. real property is like kind to any other U.S. real property. Now this is U.S. for U.S. Okay. You cannot sell U.S. property and buy non-U.S. foreign property. Okay. That is not like kind. You can buy sell foreign property and buy foreign property. That is like kind. However, you'll have difficulty finding a qualified intermediary to work with you because the issue there is not the tax deferral issue, the 1031 issue. It's about exchange rates and currency risk. So those are hard to do and they don't happen very often anymore. US for US, that's the key. Now it's important to note that not all the territories are considered US property for 1031 rules. You couldn't sell on the mainland and buy in Puerto Rico because 1031 does not consider Puerto Rico part of US, and that's true of some of the other islands as well. Okay, but within the US for US, you're golden, it's all like kind, okay? So you could sell an apartment and buy retail, office building, warehouse, apartment for warehouse. Net lease property is a common replacement, and that's the ground underneath these box tenants, CVS's, TD Banks, what have you, and people buy and sell those all the time. And you're the dirt owner, so you've invested in real property, and you've got this great leasehold tenant. Ground lessee positions for a fee interest. A fee interest means total ownership of the property. Usually when you get a deed, you have a fee interest. A ground lease, of course, you're a lessee. And if your lease is running for more than 30 years, including any options, even if you didn't extend them, the IRS treats that like equivalent to a fee. You could sell your ground lease position to somebody else who wants it and go buy something that's totally owned dirt. Now, TIC interests I talked about. You can sell fractional interests of real estate and buy fractional interests of real estate. However, you got to be careful here. There are some guidelines, some very important rules about whether that really is real estate or whether the IRS is going to look at you like you're a partnership. You might think because you call yourself tenant in common that you are definitely a real estate holder. But the IRS looks at how you've operated your business and says, we think you're a partnership, so your 1031 is no good because you cannot sell or buy partnership interests. So there's some guidance on this, and a QI will know about that, and so will your tax advisor. And you need to follow that if you do any tenant in common interests. Now, tenant in common interests sort of morphed into Delaware statutory trust interests. And again, that's the subject that Kent is going to cover more completely because they've become very popular in 1031 investments. They're a great source of replacement property for people who don't want to manage their property and they want someone else to do it. So these are all exchangeable for dirt. So you can sell your dirt, your multifamily, and buy a DST interest if you want. Vacation homes, not second homes. Now this gets a little bit more technical. There's some safe harbors on this. People have vacation homes that they rent to non-family at fair market rent transiently, maybe a few weeks a year, couple of months a year, and they also use them in that vacation spot. You have to be very careful. Is that a personal use property or an investment property? Because I told you 1031 is only for investment property. For a vacation home to be considered investment property, you got a couple of prongs here. You must rent it to non-family for fair market rent for at least 2 weeks in each of the two 12-month periods before you sell it. And we've got a likewise 2 12-month periods after you buy one of these vacation homes that you must be doing that rental for at least 2 weeks to non-family fair market. Your personal use got to be limited to 14 days or 10%. Now your personal use cannot exceed that except for maintaining it. Remember, personal use includes your family members. So if you used your 2 weeks and your brother says, I want to use your vacation home for a week, you'll be over the rule and you will be now a second home, which does not get deferral treatment. So be careful on vacation rules. Talk to your qualified intermediary. More importantly, talk to your tax advisor. We cannot give advice. And actually, I'll stop at this moment and remember to tell you that everything that I tell you is not tax advice. It's from my experience in the industry. You get advice from a tax advisor. Your qualified intermediary can only share what we've seen and know. Do not rely on us for tax advice. And anything I say today are my own opinions and statements and not the statements of First American Exchange or First American Financial. Now, basic 1031 rules. We talked about reinvesting of equal or greater value. So in my example, if you sold for $2 million and you had a $600,000 mortgage, you need to at least buy for $2 million, and your $1.4 million in cash equity needs to go into that property. Don't buy for $2 million and then have $1 million mortgage. You didn't spend $400,000 of the cash. Don't buy for $1.8 million and put all your 1.4 in, but take a mortgage of only 400. You didn't replace all your mortgage. So equal or greater in value and equity, but only if you don't want to pay tax. You can buy higher, and that would be fine. You'll meet the rule. And you can buy lower if you're willing to pay some tax. So go ahead and buy for $1.8 million if that's the right property for you, if you're willing to pay tax on $200,000 and defer the balance of your gains, okay? That's how you have a complete exchange. Reinvest all the net proceeds. Now, what it says here and replace the value of the debt, what that really means, you want to be careful here. Again, harkening back to what's all over the internet, sometimes you'll see that if you had debt on the old property, you must have debt on the new property. That is not true. You could sell property, pay off debt, and you could buy new property for 100% cash if you want to, and I've seen it done many times. There's no requirement to have debt. What this is about is that you need to make sure that all the net equity goes into the new property. And as I said earlier, that you don't over borrow on debt and such that you're not using your equity. That's what this is about. Basically, look, 1031 is this. You do not want to receive anything of value out of the property. You've told the government, don't tax me because I'm selling property A. I'm not taking anything from it. I'm simply moving my investment to property B. Didn't take any cash, so don't tax me. Well, if you take cash, you will be taxed. Now, the delayed extend time limits, these get very confusing for a lot of folks. Essentially, there are two very important time frames here. You have 45 days to either buy or identify replacement property and 180 days to close on it, okay? These start from day number 1 is the day after you close your relinquish. So if I close my relinquish today, tomorrow is day number 1. When I get to day 45, I either need to have bought what I wanted to buy, or I have to give my qualified intermediary a list of things that I might buy. You don't have to buy everything on the list, but you've got to give a list, okay? And you have to give it before midnight of the 45th day. Okay, now it's technically 11:59 p.m. on the 45th day, but the IRS lets you pop one more minute to the midnight. So if your deadline is today, you've got until midnight tonight. Now you have 180 days to buy the replacement property. The 45 and 180 both started on the same day, the day after you closed relinquish. So by the time you get to 45, you've only got 135 remaining. There's another trick if you sell toward the end of the year that you need to be careful about. If you sell between mid-October-ish and December 31st and you're a calendar year taxpayer like most of us are, you really might not get a full 180 days. You get the lesser of 180 days or the due date of the tax filing. So basically, if you sell on December 31st and your due date to file your taxes is April 15th, that will be the end of your exchange unless you file for an extension, which is automatically granted and pushes you up into, I think, October. So if you file the extension, you will get the full 180 days because then 180 will be less than your filing date. Interestingly, with the coronavirus, the government has extended April 15th to July 15th. So pretty much everybody who sold on December 31st or any time from mid-October to December 31st is getting a full 180 days on their exchange. That's the only benefit you're getting really in 1031. There's no extensions if these fall on Saturdays, Sundays, and holidays. Okay, you can't wait till Monday. You've got to send that ID to us. Now, we give you a form for it. You must sign the ID. It has to be in writing. You can fax it, email it. We don't even want originals. So you can do that on a Sunday night, okay? That's okay. But if your 180 falls on a Saturday, Sunday, or holiday, you typically can't close a transaction. You got to do it the prior business day, okay? These are very important deadlines. Okay. Now the date of transfer will be the transfer of benefits and burdens of ownership. What we really mean by that is 99.999% of the time, we are looking at the closing date in the settlement statement. That is typically when you've given up tax ownership and the other party has taken it. Your lawyers might concoct something different in a very special deal, and you can decide to advise the QI, or your tax advisor might say something else. But generally think of the closing date. I closed today. Today is the date I transferred. Okay. Now, we've already talked about no extensions. There are disaster relief extensions to those deadlines, though. If you are the subject of a hurricane, say in Florida, such as was a couple of years ago, the president might make a declaration of disaster area for Florida. If that declaration pulls in tax extensions, there's a special way that they do that. They cite a revenue procedure. You might get an extra 120 days to your 45-day ID and an extra 120 to your 180. And there's a lot of tricks to how it's applied. So just when you think you're missing a deadline, take a look at the IRS disaster relief page to see if somehow you're an affected party, and you might get extra time. Now, delayed exchange identification rules. I told you have to identify. Now, if you buy within 45 days, that's deemed identified. But let's assume you didn't buy anything and you're coming up on day 45 and you want to keep this exchange going because you really do want to close on something. You need to give the QI an identification. There's some alternate ways to ID, but they're tricky. You really generally give this to the QI in writing, signed. You can put 3 properties on that ID, and if you do, the beauty of that is there's no value limit on what you list. You could sell for $2 million and list 3 $10 million properties, no issue. If you put more than 3 properties on that, you're allowed to do it, but you must comply with a 200% rule, which means you add up the values, fair market values of everything on that ID list, whether it's 4, 5, 6, however many properties, and the total fair market value cannot be more than 2 times the value of what you sold. My example, I sold for $2 million. If you put 4 properties on there, they better not add up to more than $4 million, or you have a failed ID, which means a failed exchange. The only way to make that exchange good is to buy 95% of everything on the list. Now, don't get confused by this whole discussion, as many people do. Remember, if you only put 3 properties on this list, there's no 200% rule. I could sell for $2 million and I could list 3 $100 million properties. So stay under 3 or under, you're good. You don't even have to put 3 if you only want to put 1. However, I will tell you, after day 45, you cannot amend this list. You cannot have an exchange unless you can buy from this list between day 46 and day 180. So later, if everything gets pulled off the market and you want to substitute a property, you can't do it. Okay, those are the deadlines and the percentages. Next slide. So here, I think Kent, shall I turn it over to you to walk through this slide?
Absolutely. Thanks, Bill. Yeah, so this is what I call our decision tree. It's a little bit visual decision making. So at the top of the order, you have someone that is deciding to sell an investment property. And so Bill's already talked about the left side of this tree where someone just pays all these taxes, versus if they decide they don't want to pay all the taxes, which can easily and quickly exceed a third of the transaction of the selling price, they want to enter into an exchange. So the first thing is they need to engage a QI, a qualified intermediary, someone like Bill, that's going to basically take constructive receipt, follow the rules to identify in the 45 days and close within the 180 days in total. But really, there's another decision that needs to be made beneath that. And it's whether or not I want to continue being an active, hands-on landlord, where I'm going to have the financial obstacles, I'm going to have the management. I may be at a stage of life that I don't really want to be an active landlord, but I also don't want to pay the taxes at the same time. So there is a passive solution, which is called a Delaware Statutory Trust, which came out of the IRS section 204-86. So it's been around since 2004, but a lot of folks are just not familiar with what Delaware Statutory Trusts, or I'll refer to it as a DST, are. It enjoys all the same benefits of the exchange and the step-up in basis as Bill was talking about, but it's a passive approach. And an analogy I would give you is think about if I were to own a stock portfolio. I'm going to make the decisions of buying and selling the stock. I'm going to do my own research and analytics. I'm going to place trades. So I'm an active manager versus maybe I want to just hire a professional. I buy a mutual fund that has a track record, has a trade desk, has research, has history, and I want to turn the management over to a professionally managed team. And that's essentially an analogy you could look at for active real estate ownership through Delaware Statutory Trust structure. So these are actually a securitized form of real estate. So it's not a REIT, it's not a real estate investment trust, it's not a mutual fund. It's actually you're owning a fractional share of physical real estate. They're professionally managed. They have multiple income producing commercial properties. Investors would receive a prorated share of the income tax benefits, the capital appreciation produced by the real estate without any of the management responsibilities. So the DST holds the title to the property or properties if it's a portfolio, while multiple investors own a beneficial interest in a DST. Now, Bill referenced TICs or TICs, tenant in common, versus a DST. TICs were the original fractional ownership. They came out in 2002, but they were fraught with many problems because there was a limited number of investors. There was recourse debt. People could be suing each other. So it was quickly replaced by DST. So I'd say about 97-98% of the fractional securitized real estate marketplace is in DST structure, and a very small amount would be in tenant in common. But let me just kind of point out a few of the benefits of a DST. And again, it still is just like owning physical real estate or exchanging physical real estate. It's all about deferring federal and or state taxes on the sale of investment property. There is the same step-up in basis on death. So the heirs can if they own a DST or heirs to a DST, they would get the same step-up in basis benefits. It allows you to potentially acquire higher quality investment grade replacement property, because a smaller investor can acquire a replacement property or a portfolio of properties in different geographic locations, maybe different asset classes. So if I'm selling, we're here in New England, which has, the cap rates are out of sight, as I'm sure they are in other parts of the country. But maybe I want to diversify my portfolio and sell my 3-family and buy an Amazon industrial center, or I want multifamily in a population area that's growing. So you get to diversify or reduce your risk by building more of a portfolio approach. You can have smaller investment minimums as low as $25,000, so you could build a collection of different DST asset classes. And again, it's hassle-free investment because the sponsor's doing the work. It typically pays distributions. Right now, the marketplace, I'd say, is somewhere between 5 and 7%, depending upon the type of asset class you're investing in. And again, there's no recourse debt, so there's liability protection where I don't necessarily have that with my 3-family. And it also allows. Yes, is there a question?
I remember, this is Julia. I remember on the previous webinars, you talked about the accredited investors. Is this what we're talking about here? And what do you have to be in order to qualify as an accredited investor?
Excellent question. So my next slide, I'll transition. So this is a securitized form of real estate. So there are qualifications. You must be an accredited investor, which basically means I have to have a net worth exclusive of my residence of at least $1 million, or income exceeding $200,000 as an individual or $300,000 as a joint filer for each of the last 2 years. So but it also includes the asset that you might be selling. So if I'm selling my 3-family for $1 million, then that will easily put my net worth over that accredited investor minimum. And to give you an update in terms of the size or scope of the marketplace, for 2019, there were 38 sponsors in this marketplace, representing about $3.5 billion. There was 171 active programs. The average capital raise was about $30 million. This was represented about a 40% growth year over year. And some of the larger players are firms like Inland, Pasco, Exchange Rate, Cantor Fitzgerald. And a breakdown by the sectors, you can see that multifamily is by and far the largest sector, representing nearly 50%, followed by retail. We're seeing more grocer or housing anchored centers, so it's not just pure strip malls. Other asset classes that are gaining momentum are student housing complexes, industrial. I mentioned the example of Amazon distribution centers. And where a lot of these programs are, you can see that places like Texas and Florida are the top, because they also are tax-free states. So there's advantages. And if you look at in New England and New York, or even California, you have really high cap rates. So really, it's where the jobs are, the population growth is, where there's some tax incentives, education centers, and there's really market demand.
Ken, I have a question. Are DST investment limited to people who are doing these tax exchanges, or can any qualified investor invest?
DST sponsors will offer both exchange or direct investment. So the majority of use is typically through an exchange. There may be higher minimums as well for non-exchange transaction.
Got it. Thanks.
So,
anyhow, so I'll just also jump in and say, when you do these, you want to talk to your QI, because there's some tricks to the identification, because as Kent said, these things might be a portfolio of multiple properties. So we would work with you on their 200% rule. With that said, you just talk to your QI.
Yeah, and again, these are securities instruments, so they're not typically sold or distributed through real estate professionals. But I find that real estate professionals that are familiar with these can be more consultative to their client. For example, if I was to do a downside exchange, I sell a property for $2 million, and I want to buy a property for $1.5 million. Well, I'm going to create $500,000 of boot, which is taxable. So I could use a physical combined with a securitized form of exchange to basically wipe out any tax in that example.
Could you just clarify what the boot is?
Yeah, boot, as Bill was saying, it's like for like, and it's equity for equity, debt for debt. So if I don't exchange equal amounts, let's say I take cash off the table, then the IRS refers to that as boot, which would be taxable. And Bill, I don't know if you want to.
Yeah, it's really any value you take out. So if you take cash out, that's called boot. If you use all the cash but don't replace all of that mortgage, that's called mortgage boot. So whenever you don't replace all the value that I talked about, equal or greater value in equity, there's boot. It's just a term they use, but it's the taxable amount.
All right, thank you.
Great. So I'm going to change gears and talk a little bit about qualified opportunity funds, and then we'll get into a little comparison, contrast between the two. So by now, many of you have probably already seen maps similar to what I have on the screen right here. And again, this was basically created out of the Tax Cuts and Jobs Act in December of 2017 and became effective in 2018. But I labeled this as really a new program because final regulations were not put through until December of 2019, so just a few months ago. There was actually 3 amendments, October of 2018, May of 2019, and again, finally, December 19th of 2019. And so each one of those amendments helped to clarify, really for tax professionals and investors, kind of the rules or do's and don'ts. So I'm going to share a few insights of some of these updated amendments. And just for background purposes, I think I've shared this with you before, but these were created to provide areas for significant tax breaks for invested capital. But really, the thesis behind this is to improve the lives of those living in these opportunity zones. And so it's an innovative approach that's spurring long-term private sector investment in low-income communities nationwide. And the idea is create jobs and improve impoverished areas. And this was really a bipartisan bill that was put forth from Cory Booker, a Democrat out of New Jersey, and Tim Scott, a Republican out of South Carolina. And you see the link on this site to the EIG, Economic Innovation Group, which was really a think tank founded by Sean Parker, the original founder of Napster and the first president of Facebook. So there's a great number of resources. There's 8,762 sites that have already been defined around the country. But one point I want to make on that is this was all based upon 2010 census data. So a lot of these areas have already been gentrified. And so these are not necessarily derelict communities, but these are up and rising areas all over the country. But anyhow, so let's get into the what are the tax incentives, and there's really 3 things you need to think about: deferral, reduce, and eliminate. So first, the tax deferral. So if I, similar to what Bill had said about 180 days, if I sell any asset, not just real estate, and within 180 days I reinvest that gain into a qualified opportunity fund, or QOF, then I get to defer any capital gains tax until the end of 2026, December 31st of 2026. If I hold the investment for at least 5 years, then I get a 10% reduction in the tax that is due. Now, just to clarify, it used to be that if you also held for 7 years, then you'd get an extra 5% or total of 15% tax reduction. So what went away on December 31st of 2019 was the 7-year holding period. So right now there's a 10% reduction, but really the biggest benefit to this is really item number 3, which is the elimination of any future capital gains. So provided I hold the investment for 10 years, I pay no future capital gains whatsoever. So let's use an example. So if I put $100,000 of gains into a qualified opportunity fund, I'm going to get a 10% reduction if I hold that for 5 years. I will pay a reduced capital gain at the end of 2026, or technically when I file my taxes in the spring of 2027. I hold it for 3 additional years for a total of 10 years, and my 100,000 grew to 500,000. I pay no future capital gains. So there's really a few numbers I want you to remember. 180, which is the gain, the period I have to reinvest that gain, and I'll talk about the special advantages for partnerships. 5 is the number of period of years that I need to hold to receive a 10% reduction in taxes. 2026, which is the year I will pay those reduced capital gains. 10, which is the minimum number of years to hold to get the full step up for no new future gains. And 2048, which is when the opportunity zone provision expires in the year 2048. So if I hold it for at least 10 years and I sell that asset anytime before 2048, then there's no future capital gains. So I just referenced an exemption to the 180 rule, which I think is extremely important and really came out of the December 19th provision. That basically says, if I have a partnership, which is a pass-through entity, or let's say an S corp taxed as a partnership, then I get to elect to use the 180 days as a partner at the end of the filing period due for that partnership. So let's go through an example. So Bill and I own an office building together. We sell it today in April. Normally, each of us would have 180 days to make an election to reinvest in a capital gain. But because we own the building in a partnership, the partnership actually has an election, which they can either exercise or not exercise. And it's not until March 15th that each of us as individual partners get to start our new 180-day clock. So really, Bill and I could individually not choose the partnership to elect to do the exchange, but then individually decide that we want to do exchanges or not, and go all the way out till September of 2021 for an asset that we sold in April of 2020. So that's a new clarification, because it used to be at the end of the tax year, and they clarified that so that it's actually the tax filing date, so March 15th in my example. So let's go through a tax or investment analysis or comparison. And I'm going to kind of read this chart really from right to left. And in this example, I have a $500,000 gain that was invested in an opportunity fund in the far right column. I pay no capital gains tax now. I will pay that reduced the 90% of the taxes owed. And in this example, I'm using a 20% federal. We're using the 3.8% net investment income tax. And I am using a state capital gains tax example of 5.29. So I have nearly a 30% tax liability. So in this example, the opportunity fund over that 10-year period, I paid my taxes in 2026, but if I sold it after the 10 years, I had no future capital gains. So in this example, I made a 12% rate of return. For a non-opportunity fund to equal the same return, that same 1.4 million in this example, would have had to achieve an 18% rate of return, because I had to overcome the taxes I would have paid up front and the taxes I would have paid on exit after the 10 years. Now, I've had a lot of people say, well, wait a minute, with all this, Corona and all of the quantitative easing that's going on right now, I don't think taxes are going to do anything but go up. So what would this scenario look like in a rising tax environment? So the next slide is the exact same scenario. Now, again, my qualified and I'm using a 35% federal capital gains example versus the current 20, and I'm leaving the state the same here. So in 2026, yes, I have to pay a higher capital gains rate, but I'm getting the 10% reduction because I held it for the 5 years, and my investment equaled 1.35 million. The after-tax opportunity, the non-opportunity fund tax, whoops, a little feedback, would have had to achieve almost a 20% rate of return to catch up, because again, it's getting hit with a tax up front, and it's getting hit with a second tax down the line at the higher rate. Everyone follow me in that example?
Yeah, that's incredible.
Now, there's not every state is a conforming state. So for example, I'm in Massachusetts. We have a 5% state capital gains tax rate. So the states in red are non-conforming. New York, I know New York City is a 12.7 capital gains rate. California is 13.3. So there's actually 9 states. I kind of referenced Florida and Texas earlier that are tax-free states. So one thing I want to also point out about opportunity zones is some of the estate tax considerations. As I mentioned to you, I've had older clients say, well, why would I want to bother doing that? I don't really have a 10-year horizon that I know of. Well, the Tax Cuts and Jobs Act, which created opportunity funds in 2017, also changed dramatically the gift tax and estate tax limits, which used to be 5.5 million in 2017. In 2018, that went up to 11.18 million. It's indexed for inflation, so it's now 11.58 million. So a couple, husband and wife, could have close to $23 million in gift and estate tax exemptions under the new limit. And ironically or not, the same sunsetting of that increase goes away in 2026. So there may be more room for gifting without tax, or using my personal exemption while I'm alive. And so a point I want to make sure you understand here is inclusive events. And that basically means when I'm going to trigger deferred gains. If I sell a qualified opportunity fund before the 10-year period, I'm going to pay tax. If I sell it before the 5-year hold, I'm going to pay tax and not get the reduction. If I gift a qualified opportunity fund, again, it's an inclusive event. So what's not an inclusive event? Well, death is not. So if I have an opportunity fund and I name my son as heir, he gets to hold that for the remainder of the 10 years and exercise that, and also have the same step up in avoidance of the tax if he makes the full 10-year hold. So the other thing that's non-inclusive event is contributing an opportunity fund to a grantor trust, or let's use a living trust as an example. The trust is the same as the taxpayer. It's the same taxpayer ID, and it's a revocable trust. But I can contribute that ownership to the trust. When I die, the trust becomes irrevocable. My son gets to continue holding that asset to get to the 10-year period, and now he has an asset that's out of his estate and completely tax-free.
If you sell before the 5 or 10-year periods expire, is it prorated or it's all or nothing?
You're going to pay the tax at that time. So you're not going to get the reduction of tax before the 5-year period, but you will pay the tax that's due. So the big bang is to commit to the full 10-year period.
You also don't get to do a 1031 because you don't own real estate, right, Kent? Is that what I understand?
There's no further 1031. That's correct.
On that, sure.
Yeah.
So you do want to hold it for the whole period is the point.
Exactly, right? Exactly. Now, it's not to say that you're not going to be getting tax advantaged income coming off of the qualified opportunity fund during that period, because you, as an owner, you're going to get depreciation pass through and income off the properties. But what you have to realize is, there's different stages of opportunity funds, because these are essentially improvement and ground up development. You're talking about kind of 4 phases of the real estate cycle, where opportunistic because it's development, there's more risk up front. Core plus or core while an asset is being stabilized or completed and leased up, and then really a more mature asset on the backside. So 10 years is a long investment cycle. So we'll talk about some due diligence in a minute. So a couple of the comparisons I want to share with everyone is between the 1031 and the opportunity zone. As Bill mentioned earlier, 1031 is only real estate gains, but opportunity zone investment is really any capital gain. It could be securities, it could be a business, it could be art, Bitcoin. You do need to have a qualified intermediary like Bill in a 1031. You don't need a qualified intermediary to sit in between the transaction for an opportunity zone. And again, these are also kind of the cleanup batter. So if you screwed up your 1031, you didn't identify in the 45-day period, or the property had issues, you couldn't get your financing, and now you're facing a massive tax bill, you still have another option with a qualified opportunity fund. And one point of clarification as well, I only get the tax benefits if I'm investing in a qualified opportunity fund. Just because I own property that's in a qualified opportunity zone does not equate to a tax benefit. We talked about the 45 days with Bill, in 180 days with an opportunity fund with an extension if you have a pass-through entity like a partnership or an S-corp taxed as a partnership. In the 1031, again, it requires you reinvest all the proceeds of the sale. Otherwise, you could be subject to paying boot. With an opportunity fund, you're only investing the capital gains portion, and I'll give you an example. So let's say, for example, we had a client that had a building with an adjusted basis of $1 million and a current fair market value with no debt of $2 million. If the client did a 1031 exchange to a new property and exchanged $1.6 million and took $400,000 of cash out, well, then the cash, they'd have to pay tax on the $400,000 under the 1031B rules. And so they're only deferring $600,000 in that example. Alternatively, if a client sells a building for $2 million cash, he can retain $1 million of cash, which was his original basis, reinvest the remaining $1 million, which is the gain, in a qualified opportunity fund within the 180-day window, and defer $1 million of gain under all the rules I just shared with you. So you really do get a second bite of the apple with a qualified opportunity fund. I would say due diligence is critical. As I mentioned, these are ground up development properties. You can invest more than just real estate, but for due diligence purposes, I think most of the opportunity funds in the marketplace are real estate based in different asset classes, as we talked about: student housing, multifamily, office, hospitality. And I would say also don't base your evaluation on these based upon IRRs or internal rate of returns. There's many factors that need to be considered. And the last couple of points here. Again, you're eligible for a full step-up in basis with a 1031 exchange. You don't get a step-up in basis upon the disposition. There's no recapture of depreciation or tax on the appreciated market value. Any questions? And actually, we have a more detailed version of this comparison. There's a text-back system. If you use the 44222 and enter in 1031 versus OZ, you'll get a more extensive comparison between the two.
I just did this, everyone, and it took me 2 seconds, and I already have the download, and it's beautiful, 2 pages. So recommend, and it's in the chat in case you lose this slide.
Perfect. So in the interest of time, I think the only comment that we wanted to make here regarding how some sectors are affected by COVID, obviously things like hospitality or hotels, malls are really more high-risk assets. And I'd say that whether you're using a Delaware statutory trust, you're using your own investment in physical real estate or opportunity funds, I think that this high to low risk scale is applicable in the exchange. So just a couple of thoughts in terms of asset classes. We have included a couple of resource sites, one for 1031 DSTs, one for opportunities funds, and then finally Bill, as a qualified intermediary, has a couple of sites that has a number of resources available. With that, I will close it out for any questions.
And Kent, I just want to make one point on. It's interesting because when this first came out, the opportunity zones, some people were talking in terms of either or. It had to be one or the other. Both of these strategies are going strong. So for some people, the 1031 works out fine. They don't pay any tax and they keep deferring. For other people, they really prefer the OZ. Some people actually mix them with one property. So you don't have to think one or the other. It's whichever suits you for a variety of reasons.
Hey, Bill, I have a question for you. With a 1031 exchange, can you buy for cash and then add debt post-closing if, like, say you don't have enough time to get the debt once you
Yes. Yeah, so the basic rule accepted by just about all tax advisors is that you can refinance anytime after the acquisition in a 1031. You don't want to do it at the acquisition table and have too much cash there. The IRS might look at that as not really using your cash, but afterwards, I've heard people say a nanosecond, a week, a month. Some advisors like to see 30 days or 6 months, but yes, you can always refinance to pull your cash out.
And Kent, on that last slide where you were identifying the different risk classes in today's world, are you saying the return adjusting to match the level of risk?
Well, I think one of the things you need to think about, especially for an opportunity fund, we're in the middle of a recession currently, and so obviously you look at vacancies on hospitality as an example. Well, these are really assets that aren't going to come online for 2, maybe 3 years because they're in the capital raise or the development stage. So you really have to look at these as long-term investments. So I think some of these are going to be harder hit for current existing assets and vacancy issues. But because of the development nature and the fundraising nature of opportunity funds, they're not going to be hit as hard. And in some cases, they may be able to negotiate better, fees in terms of debt, in terms of labor. So that there could be some advantages to a recession hitting early in the cycle.
And how liquid are these funds? I mean, if you want to sell, do you have to wait, on a quarterly basis? Can you just get out? I want to sell today. I can sell today. like any stock or bond, or is it?
No, so I'll give you two quick answers. So a Delaware statutory trust, because they are two different animals, typically have a life cycle of 5 to 7 years. So right now there's no secondary market for DSTs or Delaware statutory trusts, but the fund sponsor sits on the same side of the table as you, wants to buy low, improve, flip, and sell high. So the typical investment period is 5 to 7 years. Opportunity funds, you need to look at the commitment for the full 10 years to get all the tax benefits. And again, there is no secondary market because this is a fairly new space.
And how much of the fund sponsors own equity are you looking to see in a fund before you recommend it to one of your clients?
Yeah, that's a great question. And again, it varies by sponsor, it varies by asset class, but you always want to have them have a seat at the table and committing their own capital. So that they're, typically a lot of these are waterfall equity deals, so they're not making as much along the way. I mean, they certainly have some fees for managing the properties, but really they're not going to get paid until a preferred payout or dividend is paid to the investors. So they're really looking to make the bulk of their return on the end of the 10-year period for the ozones.
And during the course of that 10-year period, can they be opportunistic in selling as long as they replace assets in that?
Yes, that was something that was clarified in the December amendment. Great. That is allowed.
Wow. Okay. Well, I don't want to be the question hog. Does anybody else listening have anything they'd like to ask? You can feel free to unmute yourself or put something in the chat. And also, well, for questions, if folks want to get in touch with you and Bill, what's the best way to do that?
Our contact information is on the screen, and I think you're recording this deck, so it's in there as well.
Excellent. Well, we will be sending out the recording and we'll link to the recording and to the slide deck because there was a lot to absorb. I mean, thank you guys. This is now the third time, Kent, that I've heard you talk about these, and I think I'm beginning to get it. So I would encourage.
It takes about that many times or more.
Yeah.
So call us.
Really understand it, but I'm getting there. So thank you so much. Both of you have explained, these really complex topics in very understandable ways, and so thank you again for your time, and to all those people that are listening and watching for their time. And we are living in a very unique period in American life, and even if we can't go outside, it doesn't mean we can't still learn a lot and get value from the time that we are spending working from home. And so we're especially grateful to you guys for sharing your incredible knowledge with us.
Well, Dave, I'd like to leave you with just one maybe optimistic thought in our quote, and it's life isn't about how we survive the storm, but how we dance in the rain. So with that, thank you for having us.
Thank you very much for having us. Yes.
And just wrapping up, thank you, Julia, for your help in organizing this today. Thanks to everybody watching, and once again, thanks to the News Funnel for sponsoring. And Kent and Bill, thanks, and maybe we can do this again in a few months.
Love to. Have a great day.
Thanks, everybody.
Thank you. And you did a fabulous job.